this year from the Fed. 2 more interest rate rises potentially because of sticky inflation. It's the European Central Bank next. 25 basis point interest rate rise expected. All this has given a twist to precious metals, with gold ticking lower, knocking on the door of a 3-month low. And we've seen some economic weakness in China coming through in the first and now second quarters of the year. As a result of that, we've got the People's Bank of China, the central bank there, shifting to stimulus mode, giving the markets more money, more liquidity, cutting interest rates, and seeing what happens as a result of their policies. Take a look at volatility. Yesterday, we saw another tick lower for volatility. In fact, we closed out at levels not seen since early 2020. So we're now more than 3-year lows for volatility as we see these equity markets spike up. Before we take a look at the US, which I think is where much of the news has come through from for the last 12, 14 hours or so, I wanted to show you what's happening here in the European markets. This is the daily candles. You can see that we have a red candle here today. We are expecting a slightly lower start, not just the London markets, but also to Germany as well. So if you're an intraday trader, it's a short trade. That being said, yesterday, intraday, we saw a new all-time intraday record high for the German DAX. We saw it just peak up just by a couple of points above the 16,335 level mid-session yesterday. Then comes the pullback, looking for a lower start on the European markets this morning for the German DAX. Same for the French CAC 40 after a peak higher there to 2-week highs for the French CAC 40. All this coming ahead of the European Central Bank interest rate decision, which is due at 1:15 p.m. today, UK time. Will be live on the IG platform for that. Let's take a look at what's been happening overnight in the Asia-Pacific markets. Bit of a mixed bag overall. Nikkei 225 actually ending down on the session today. But we got gains in the Chinese markets. Hang Seng Stock Index up 1.25% when last looked. S&P ASX 200, the Australian benchmark, did eke out a gain. On a mixed session today, we saw a rise of almost 1/5%. But as I said, it really all circled around what happened with the Fed last night. US markets yesterday, we saw a drop for the Dow, but gains on the S&P 500. NASDAQ stealing the limelight and the upside with a rise of almost 0.4%. If you look at what's been happening on that index particularly, this continues to knock higher. 41% up now from the beginning of the year. Richard Snow and I were live on the platform last night, witnessing what was going on in the wake of the Fed decision to leave interest rates on hold. The initial reaction was one where the markets saw the value of what was going on, and then all of a sudden realized, in fact, there was now no chance of an interest rate cut this year. Rather, there were 2 interest rate rises to come, potentially next month, which is the back end of July, and possibly again in the early autumn. But no interest rate cuts this year. About 100 basis points of cuts possibly next year. But by then, some are saying the US will have gone into recession. We'll have to see how things develop. But at the moment, at least, it's looking as though risk assets continue to be of interest. And it's technology stocks, broadly speaking, with the big gainers. Yesterday, we saw a punch higher to a 13.5% rise year to date, the S&P 500. Since then, there has been a drop. We're now expecting a lower start to the trading day on the S&P 500 so far on the session of the 24-hour markets. So the Fed last night is widely expected, the US Central Bank leaving interest rates on hold. The target rate was kept between 5 and 5.25%. For the first pause after 10 consecutive hikes that took rates 500 basis points up from flat. But the fight against inflation is not yet over, according to Jerome Powell, the chairman of the Fed. US growth and jobs markets holding up better than anticipated, according to the Fed last night, giving room for the Fed to continue its campaign to limit price rises. The Fed chairman signaled that borrowing costs may still need to rise, though, by as much as half a percentage point by the end of the year. All 8 other officials were given the vote, 9 in total on the voting committee, including Jerome Powell. Many of them deciding it was a unanimous decision last night. As for the market, CMA FedWatch tool pointing to a 72% chance of a 25 basis point hike next month. Now, let's look at the economic projections, because that was really what all this was about yesterday. It was the quarterly package of economic data points to watch out for. The FOMC said it sees unemployment rate rising by the end of 2023, 4.1%, currently 3.7%. You can see a bit of stress coming through in the jobs market. That is significantly lower than the 4.6% jobless rate officials projected though back in March. So to a degree, that's not as difficult to swallow. 2023 economic growth rising to 1% from 0.4% in the March projections, and core PCE is seen dropping from the current 4.7% to 3.9% by the end of 2023, which is good news for the Fed. It still wants to target that 2% area for inflation. Now, this, of course, at 4.7% is higher than the 3.6% projected in the month of March. Sorry, 3.9% is currently higher than the 3.6% projected in March. So despite the fact that inflation is falling, it does remain sticky. I want to show you a chart for the US dollar basket. You can see here today, in fact, it fell yesterday, but today we've got a bit of a rebound underway at 102.91. I'll take a look at what's happening with the euro dollar in just a minute when I look at what's going on with the European Central Bank. But spot gold was affected, and indeed it is remaining so today. It's now below the 100-period moving average. This is the first time we've seen a print below that since the 10th of November last year. So we've got that impetus now beginning on the downside. MACD is turning around. We're currently trading at 1933, and that is the lowest we've seen there since the 17th of March. If you are a day trader on gold, your short position will be accompanied by a stop around about the 1970 level. 1934 is where we are. 1910 is your price target, and that will be down here at levels there not seen since the 15th of March. You get a candle close below the 1910, 61.8% retracement. You're then on the way down to this next line of support at 76.4% Fibonacci at 1870. That would then take you down to levels not seen since the 10th of March. And the market's continuing potentially, possibly to go on further on down if we see more interest in the US dollar. You've got a total retracement, which will take you back to the beginning of this fib back on the 28th of Feb at 1804, which would be the total retracement if that's the price target, which are particularly negative on the price of gold and other big precious metal moves as well. A bit like what's going on with gold. Let's take a look very briefly at what's going on with spot silver. The spot silver has seen some negativity the last couple of days, but it's not quite as negative in the longer term picture as the price of gold at 23.44. Now, today, the European Central Bank very much in the limelight as the focus shifts onto what the European Central Bank is doing for the Eurozone. Christine Lagarde is expected to announce a 25 basis point rate rise before another one in July. Then the ECB is believed to go on to wait-and-see mode for the rest of the year. That's according to a poll conducted by Reuters, which indicated that economists believe inflation across the single currency economies remains elevated. I want to show you the euro-dollar trade. We're talking there a little bit about the interest on the US dollar basket, and this has seen a little bit of a pullback on the euro-dollar trade. Initially, it certainly seemed yesterday as though it was a fairly dovish report from the Fed, which led to more strength of the euro against the US dollar. But you can see in today's session that's unbound to a degree at 108.09. This longer-term trend on the way up remains, and if you believe that to be the case, at 108.09, if you're long on this, stop goes below this line of 61.8% retracement at 107.38, so you'll stop at around about the 107 level if you're long on the euro-dollar trade. Now, after 375 basis points of hikes over the past year, economic activity across the euro region has slowed. Germany, Europe's biggest economy, is or has been into a recession over the winter period between Q4 and Q1. So one might think a pause could be on the cards. Reuters poll also said both Germany and the Eurozone are expected to rebound this quarter, Eurozone growth of 0.2% in each quarter of the rest of the year. So things are beginning to develop on the upside after that recession. Now, a set of macroeconomic indicators released this morning in China reinforced the case that more stimulus is needed across the Chinese economy. This is the world's second largest, of course. China industrial output rose 3.5% in May from this time last year, and that missed expectations and slower than the 5.6% expansion reported back in April. Ditto for retail sales up 12.7%, missing forecasts of 13.6% growth and slowing from April's 18.4%. Investment in the property sector declining. This was accentuated in the first 5 months of the year, down 7.2%. Private fixed asset investment shrinking 0.1% in the period. And whilst the jobless rate remained 5.2% in May. Youth unemployment jumped to a record 20.8%. Authorities are going to be a little bit concerned about this because it's that area of the social structure which is most flexible, and they can respond using social media and potentially cause unrest. The Chinese authorities will be more than well aware of this. 2 days after cutting two key short-term policy rates, China's central bank has cut the borrowing cost of its medium-term policy loans by 10 basis points, 6.5%. So more stimulus. I want to take a look at what's been happening with the Chinese yuan. This is the Chinese yuan against the US dollar. This is the dollar rising against the yuan. In today's trade, you can see a little bit of money taken off the table for the dollar in favor of the Chinese yuan. But broadly speaking, this is a market moving pretty much only in one direction. And as of yesterday's high point for the dollar, which was the highest I've seen since November last year. So you can see weakness in the Chinese economy prevailing with that drop in the Chinese. Let's move on, take a look at what's been happening in other economies around the world, because a lot of economic data out over the last 12 hours or so has affected markets. In Japan, 22nd straight month of trade deficits. These are the numbers. Trade deficit widening to 1.37 billion yuan in May. Exports only, rising 0.6% year on year, the softest rate since early 2021. Imports down by a margin of 9.9%. Quick check on what's been happening with the Japanese yen. That's weakened again, and you can see here with this US dollar now peaking above that previous line of resistance at 140.92. That's now gone up to 141.34. With a breach of that line there, that now takes us back to levels not seen since November last year, and into this area up here where the Japanese authorities like to come in to support the Japanese yen. The US dollar rising against that weaker Japanese currency, causing a little bit of concern for the Japanese. There's the Bank of Japan interest rate meeting first thing on Friday. Now, the New Zealand economy has tipped into a technical recession, according to the data out today that we've seen. GDP matched analyst expectations of a 0.1% contraction in the March quarter, but was well below the Reserve Bank of New Zealand's forecast of 0.3% growth. Furthermore, fourth quarter GDP was revised to a contraction of 0.7% from a decline of 0.6%. The effect of this cuts the risk of more rate rises, but creates a new headwind for the government's re-election hopes. There's not really been much move on the markets as a result of all this. I want to show you what's been going on with the New Zealand dollar against the US dollar. This move up that we've seen for the Kiwi against the US has halted to a point today, 61.78. So not much move on the markets, but I think a technical recession is something of an historical point to look out for in the Kiwi economy. The Australian dollar is one of the enduring currencies on the session in today's trade. In Australia, the jobs market was stronger than thought in the month of May. The unemployment rate unexpectedly fell to 3.6%. And economists anticipated it to remain at 3.7%. It's not a big move, but nonetheless, it has been significant for the Australian dollar in the session in today's trade. Full-time employment rebounded 61,700 from April, and part-time employment also rose. I want to show you what's happening with the Australian currency, because there have been some really interesting moves. Now, in the last couple of days, we've seen the Australian currency rise and rise again. In fact, in the last 12 hours, we've seen it peak above this previous line of resistance at 61.18 against the US dollar. So that upward trend continues against the greenback. Against the New Zealand, big strong move up on the Australian market in today's trade. Not as high as it has been, but against other currencies, there have been some very strong moves. In today's trade, we've gone above the 100-period moving average for the Aussie against the Canadian for the first time since March this year. So a lot of moves shown benefit for the Australian dollar. The Australian yield curve has inverted for the first time since 2008. Now, this often indicates incoming recession. Could that happen in the Australian economy? Last week, the RBA unexpectedly raised interest rates to 4.1%. It's more of a brake on economic activity. It also signaled that further tightening could still be required to tame inflation. Strength of this jobs report, though, today suggests the RBA's case tight labour market will contribute to stronger wage growth, but the inverted yield curve is something I think that the central bank keep an eye on, because That indicates a recession coming in for the Australian. So let's take a look at what's happening in Australia. As to close this long look at the macroeconomic picture, just wanted to quickly update you on what's happening then. The state's retail sales expected to drop by a margin of 0.1% in May month. Initial jobless claims expectations 249,000, and industrial production forecast to rise 0.1% in the month of May, month on month. Now let's switch out of the macroeconomic data and go on to corporate. Just one headline coming through this morning I think it's worth looking at. ASOS, the company, continues to execute on its driving change agenda. But if you look at the numbers, all a bit strange. It's all about taking stock right down with less inventory. It's focusing on fewer customers, those that are profitable. This has led to lower revenue down 14% as expected, and reflecting the deliberate actions on capital allocation to improve profitability. But the company has also said that adjusted gross margins are up 350 basis points year on year. It's very difficult to put the two side by side because clearly they're contracting. Clearly they are running inventory down, which costs money. They're apparently able to sell this inventory at full price. One wonders why they haven't done it before. But the gross margin is increasing, which technically should, in theory, give a boost to profitability. The company says it's on target for full year trading figures as anticipated on profit. Quick check on what's been happening with ASOS stock. Down, 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 and down again. A massive head and shoulders picture here. We've got a print at the start today of 328. This is the lowest level of stock for the stock price we've seen since the 30th of November 2009, and it looks like, I think, this is going to go down lower still. They've got 320 pence support. 328 is where the stock will open at the beginning of the session. Halfords was due to report full year numbers this morning. Just announced they now expect to report next week, on the 21st of June, the longest day of the year. Now, Adobe is one of the stocks to watch after the close of the US markets this evening with its earnings. Analyst Angeline Ong, who's been following the company shares, and tells us what to expect. Stock and the news out after the bell tonight.
Much of the buzz around Adobe will be AI and Firefly. I can tell you that ahead of its results, though, many brokers have raised their price targets. JP Morgan raising the price target on Adobe to $450 from $380. It expects Adobe to demonstrate relative resilience despite what it says continues to be a choppy macro backdrop for enterprise. Much of the buzz around Adobe will be AI and Firefly. I can tell you that ahead of its results, though, many brokers have raised their price targets. JP Morgan raising the price target on Adobe to $450 from $380. It expects Adobe to demonstrate relative resilience despite what it says continues to be a choppy macro backdrop for enterprise software peers. Wells Fargo also upgrading Adobe to overweight on its AI advantage and hiking its price target, calling Firefly a much-needed next act for the company. And speaking of Firefly, this is where the AI comes in. Adobe's pushing Firefly AI into big business, offering financial cover, but no details as to what this cover is just yet. The thought behind this is that Adobe says its images used in its Firefly generative AI tool are all stock images or from the public domain with appropriate licenses. And if you get into hot, unknown, sticky territory, then you are covered if you are a client using this AI service.
As we saw, the share price rising recently. It ended the session up yesterday after declines the previous day. But I think if we do get anything that resembles the support of what we've seen for this, these tech stocks generally, there's the potential possibly to go up. It's not an all-session stock on the IT platform, but certainly a stock worth watching after the close tonight. Now, oil prices took a knock yesterday afternoon after the EIA posted a surprise increase in oil stocks. Let's take a look at the numbers as the EIA published the figures. Crude oil stockpiles rising by a whopping 7.9 million barrels last week compared with analyst expectations of a draw of 500,000. Gasoline stocks rising also saw distillate stockpiles also up, indicating that there is a lot more oil around in the market than many had been anticipating. It wasn't a big move lower yesterday, but we are holding on to the losses. This is US crude. If you look at the chart at 68.81, but I think the direction of travel, for me at least, continues to remain on the downside, especially as we've got this weak picture developing. That's it. We've got 10 minutes to go before we start today's European session. Still looking for losses across the board. Do watch out for ASOS stock at the start of today's trade. We're back at 10:30 with